In this lecture, we'll be reviewing capital investments and the decisions related to those. First, we have to understand what a capital investment is. A capital investment is a big purchase a company is going to make that they have to strategically plan for. Something that might make more sense to you is if we look at some of the capital investments that you make, like getting a college education. That's a big expense that you're willing to put out because you know that this will pay off in the future. Same thing like teaching a son or daughter how to cook. You know that's a big time commitment to initially put in, but in the future maybe you might not have to make dinner every night. So there's a couple ways that we look at these capital investments and whether or not we should invest in them. There are two methods that do not use present values. This is the average rate of return method and the cash back method. The methods that use present value tables are the net present value method and the internal rate of return method. First, let's look at the average rate of return method. The average rate of return requires two equations. First, we have to figure out what the average investment is. To calculate the average investment, we take your initial cost plus any residual value. Your residual value is the same thing as your salvage value. And we'll take those two numbers and divide that by 2 to get my average investment. Then I can use the average investment and put it into my equation for the average rate of return. In the average rate of return, I'll take my estimated average annual income and divide that by my average investment. The annual income may have to be calculated. You have to take a look at only annual income compared to what this investment might earn you over multiple years. For example, let's take a look at this decision whether or not we should invest in this new machine. The cost of it is $500,000. The total income from the machine is $200,000, but its expected useful life is 4 years. Therefore, if we wanted to get our annual income, we would take that $200,000 and divide by 4. So our estimated annual income is really $50,000. That's what we would get every year. To get that average investment, we're taking the initial cost and dividing it by 2 since there's no residual value. And then we'll take that annual income and divide by our annual investment to get an average rate of return of 20%. We would compare this to what we require our rate of return to be, and if it's equal to or above, we would consider that investment. The next method we can look at to analyze an investment is our cash back method. Your cash back method looks at how long does it take to recover your initial investment. To do this, we take our initial cost and divide that by our annual equal net cash flows. If our cash flows are not equal every year, we cannot use this equation. For example, if our cash flows are equal, we would just take our initial investment, divide that by our equal cash flows, and it would take 15 years to recoup our investment on this product. If that's acceptable for our management, we might consider this investment. If cash flows are not equal, then we just have to go through each year and add up that net cash flow until we recover our investment. Therefore, in this example here, we look at that cumulative net cash flow until we recover that initial investment. The net present value method uses the present value tables to figure out what our present value of the cash flow we expect to receive is now, and then we'll compare that to the cost of our equipment or whatever that purchase is, and see whether our net present value is positive or negative. We are looking for a net present value of 0 or above. So to walk through this example, we look at our cost of our new equipment as $200,000. We expect to use that for 5 years, and we have a minimum desired rate of return of 10%. We will gather the information of what we expect our cash flows to be received for each year that we hold this investment. Then what we're going to do is take that cash flow and multiply it by our present value of $1 at 10% for each of those years related to that cash flow. For example, you can see our present value table of $1 below, and at 10% for 1 year, our present value factor is 0.909. Therefore, in year 1, we would take that cash flow and multiply it by 0.909 to figure out what our present value of the cash flow is. We would then do that for year 2 and look to year 2 at 10% to find that factor of 0.826 and multiply it by your cash flow for that year. We would do this for each year of the investment. We'll add up the total of all those present values to figure out what our present value is. Then we subtract our initial investment to figure out what our net present value is. Again, we're looking for that net present value to be 0. If it's 0, that means we met that minimum required rate of 10%, or above. If it's above, we exceeded that minimum required rate of return of 10%. I want to go through an example of net present value using an example where we get the same amount of cash flow every year. In the previous example, our cash flows were different each year, therefore we had to use that present value of one table. If our cash flows are the same amount for every year, we can use that present value of an annuity table and save us a little bit of time. So in this example, we get $50,000 every year for 7 years. Our rate of return that we would like to have is 12%. And so we'll pull up that present value of an annuity table. We look up 12% and we'll look up 7 years. This is just 2 spots under that highlighted yellow piece. So we find a factor of 4.564, and we'll multiply that by our net cash flows to give us our present value, which is $228,200. We subtract our initial cost to get our net present value. Now in this example, our net present value is negative $11,800. Therefore, this would not be a great investment because our net present value is below 0. To look at a present value index is another way that we can see whether an investment would be profitable. And to get that present value index, we take our total present value of net cash flows. Again, you're not using that net present value, you're using the present value, and you divide that by the amount to be invested. You want your present value index to be greater than 1. In this case, because we have a negative net present value, our present value index is below 1. And finally, the last way that we can evaluate our capital investments is by using the internal rate of return. The internal rate of return computes the rate of return based on what you expect your net cash flows to be. Therefore, we can use an equation to find out what our present value factor for an annuity would be, and then we'll use that factor, look it up on our table, our present value of an annuity table, to figure out what rate of return this investment would give us. So let's walk through this example. Again, first, what you're trying to do is find that present value factor for an annuity. And to do that, you take the amount to be invested and divide that by your equal annual net cash flows. Again, you're looking for those annual cash flows. So in this example, our cost of the new equipment, or the amount to be invested, is $97,360. We expect every year to get $20,000. Therefore, our present value factor would be 4.868. Then what we're going to do is pull up that present value of an annuity table. We know that the expected useful life is 7 years. So we'll go across the 7-year mark until we hit that factor, that 4.868 that we just figured out. And then we can look and see what column that rate of return represents. In this example, it represents a 10% rate of return, or internal rate of return. Using these 4 methods, first, the 2 that do not use present values, that average rate of return and the cash payback, and those 2 methods that use present values, looking at the net present value or that internal rate of return, we can evaluate whether a capital investment is a good decision or not.